There is something that the smart money figured out decades ago that the average depositor has never been taught. Not because it is complicated, not because it requires wealth or connections or access to systems that most people cannot reach. Because the institutions that profit from your ignorance of it have spent decades ensuring it stays out of the mainstream financial conversation. Let me tell you what it is. In 1929, 9,000 American banks failed. Depositors who had done nothing wrong, who had followed every piece of conventional financial wisdom available at the time, walked up to their institution and found the doors locked. Their capital, in many cases, everything they had saved across a lifetime of work, was gone, or frozen, or worth cents on the dollar. But not everyone. A specific subset of depositors emerged from the worst banking collapse in American history without losing a single dollar, not 1 cent. They were not wealthier than the people who lost everything. They did not have access to inside information. They did not predict the specific timing of the failures. They had built a different structure, a structure that placed no intermediary between their capital and their ability to access it. A structure with no single point of failure that could lock them out. That structure was systematically removed from public knowledge in 1967. Not because it failed. It never failed. Not one depositor who used it lost a single dollar during the Depression. It was removed because it worked too well, and because the banking industry had spent decades lobbying against its existence. In 2026, its functional equivalent still exists, built by the United States Treasury Department, available to any American with a computer and 15 minutes, and almost nobody in mainstream finance is talking about it. Here is what makes 2026 the specific moment to understand this. Not the history, the present. 3 things are happening simultaneously right now that the people who built this structure in 1929 would have recognized immediately, not as a crisis, but as the early warning pattern that precedes one. A bank in Chicago failed earlier this year, the first bank failure of 2026. When regulators described the cause, 82% portfolio concentration in commercial real estate and private equity assets that cannot be liquidated quickly against deposits that are callable on demand. They were describing a structural fragility, not an isolated incident. Structural fragility does not stay isolated. It spreads through the interconnections that characterize the banking system. Simultaneously, the current administration is engaged in active discussions about restructuring the Federal Deposit Insurance Corporation, potentially dissolving it into the Treasury Department. Staffing has been cut. The budget has been reduced. Regulatory experts have stated publicly that these cuts weaken the agency's capacity to respond to stress events. The people making these statements are not outsiders. They are banking regulators. And Congress, from both parties, is currently debating raising deposit insurance coverage limits from $250,000 to $10 million per depositor. Stop and think about that for a moment. A 40-fold increase in proposed coverage limits. If the current system adequately protects depositors, there is no reason to raise limits by a factor of 40. The scale of the proposed increase tells you something specific about what the people who understand the current state of the banking system actually believe about its adequacy. The smart money is already reading those signals, already repositioning, quietly, without press releases, without alarm. That is what smart money does. It moves before the event becomes a headline. After the headline, the opportunity has already closed. This is Capital Briefing. If you are here for the first time, subscribe now before we go any further. What we build here is financial intelligence, the kind that creates positioning advantage before events become public, before the crowd moves, before the cost of action rises sharply. Subscribe now. Activate notifications. Then let me show you the 4-layer architecture. Before the layers, understand the fundamental distinction that separates the people who lost everything in 1929 from the people who lost nothing. It was not prediction, it was not wealth, it was structure. Specifically, the presence or absence of an intermediary between the depositor and their capital. When you deposit money in a commercial bank, your capital is no longer yours in any meaningful operational sense. It is the bank's liability to you. The bank deploys your deposit into loans, securities, and investments. If those assets become impaired, if their value falls faster than the bank's ability to service its deposit obligations, the intermediary fails. Your capital is trapped behind that failure. The insurance system may eventually make you whole. The timeline for that resolution may not be compatible with your actual needs. The people who survived the depression without losses had found a way to eliminate that intermediary. Their capital was not behind a private institution's balance sheet. It was directly with the government itself. That distinction, an intermediary present versus no intermediary, is the entire architecture. Layer 1, operating cash at a federally insured commercial bank. You cannot avoid this layer. It is the functional infrastructure of daily financial life. Payroll deposits, automated bill payments, debit card transactions, these require a commercially banked account. This layer is necessary. But here's what most people do not think about. Necessary does not mean sufficient, and necessary does not mean unlimited in exposure. The FDIC insures up to $250,000 per depositor, per institution, per ownership category. Under normal conditions, that insurance is real and it functions. The FDIC has resolved hundreds of bank failures without depositors losing insured balances. But the system has structural constraints that matter under stress. The FDIC's Deposit Insurance Fund holds reserves equal to approximately 1.25% of total insured deposits. 1.25%. That is the buffer between you and the claim process if your institution fails. Under normal conditions, isolated failures, staggered over time, that ratio provides adequate protection. Under a correlated stress event, the specific scenario that a structural fragility, like the one that took down the Chicago bank, tends to produce, 1.25% is not a meaningful cushion. The 2023 failure of Silicon Valley Bank, followed by a second failure within 48 hours, temporarily stressed exactly this framework. The resolution required emergency intervention from the Federal Reserve and Treasury that went beyond the standard FDIC process. That is documented. That happened recently. That is the recent stress test result for the system you are currently relying on. Keep this layer. Keep the operating balance you need for monthly function. Do not concentrate beyond what operational necessity requires. Layer 2. Credit union deposits under the NCUA's independent insurance framework. Here is a structural fact that most depositors do not know. There are two entirely separate federal deposit insurance systems operating in the United States, and they are genuinely independent. Commercial banks are insured by the FDIC. Credit unions, member-owned, non-profit financial cooperatives are insured by the National Credit Union Administration, with its own statutory framework, its own insurance fund, and its own federal legal basis. $250,000 at an FDIC bank and $250,000 at an NCUA credit union is $500,000 under two structurally independent federal insurance frameworks, not the same system with two buckets, two different systems, two different legal authorities, two different insurance pools. This independence matters specifically in a scenario where one system comes under stress. If the FDIC's fund faces claims from a correlated bank failure event, the NCUA's fund is not affected. The two systems do not share exposure. There is a second advantage to credit unions that goes beyond the insurance independence. The institutions that survived the 1929 to 1933 collapse at dramatically higher rates than commercial banks were depositor-first structures. Savings and loans, mutual savings banks, credit unions, not because their management was smarter, because their legal structure was different. These institutions were owned by their depositors, not by outside shareholders. They did not have profit motives pushing them toward aggressive deployment of depositor capital into speculative positions. They concentrated their assets in conservative local lending rather than in the call loan market that financed stock market speculation. Over 40% of American commercial banks failed between 1930 and 1933. The depositor-first institutions, structurally identical to modern credit unions, survived at dramatically higher rates. Structure determined outcomes, not luck. Subscribe to Capital Briefing if you want to keep building this understanding. What we publish here is financial intelligence, not advice, not prediction, but the structural analysis that creates positioning clarity before events force decisions under pressure. The next video examines what the specific balance sheet composition of regional banks currently shows about where the next stress event is most likely to originate. Subscribe now. Then let me give you layers 3 and 4. Layer 3, physical cash in the correct denominations outside the banking system. The instinct to hold physical cash as part of a protection architecture is correct. The implementation of that instinct is almost universally wrong. Here is the specific historical lesson that has been forgotten. During the bank holiday periods of the early 1930s, depositors who had the foresight to hold physical cash outside the banking system encountered a specific practical problem. They had money. They could not transact effectively, not because merchants refused cash, because they had the wrong denominations. Large bills, $50 and $100 notes of the era, could not be used when the other party had no ability to make change. The person with a large bill and a need to buy groceries could not complete the transaction if the grocer had no small bills to provide change. The person with ones and fives transacted normally. This specific detail, denomination matters, is absent from every modern discussion of physical cash as a financial protection tool. It was documented in oral histories from the Depression era. It has not been carried forward into contemporary financial education. The practical implementation for 2026, 1 to 4 weeks of normal household operating expenses in mixed small denominations, ones, fives, tens, and 20s, held in a secure location outside the banking system. This is not investment capital. It is not inflation protection. It is a transaction bridge specifically for the scenario where digital payment infrastructure is temporarily disrupted by a bank holiday, a cyber attack on payment systems, or a regional banking stress event that freezes electronic access before physical resolution occurs. The cost is the foregone yield and the slow erosion through inflation. Those costs are real. They are the premium for a specific, narrowly defined insurance against a specific, narrowly defined operational risk. Layer 4. Direct government securities. No intermediary, no insurance limit, no bank in the chain. This is the layer that has the most significant historical precedent and receives the least attention in modern financial commentary. It is also the layer that is most directly analogous to what protected depositors in 1929. Let me give you the history first, because the history is what makes the mechanism credible. In 1911, Congress created the United States Postal Savings System. Any American could deposit money directly at any post office in the country, not at a private bank, not through an insurance fund backstopping a private bank, directly with the government of the United States. The full faith and credit of the sovereign, not a promise from an intermediary, backed every dollar. When the commercial banking system began failing after 1929, the data on what happened to this system is unambiguous. Total deposits in the postal savings system grew by approximately 800% between 1929 and 1934. 800%. This growth was not driven by competitive rates. The postal system deliberately paid only 2% to avoid competing with commercial banks. It was driven by the complete absence of intermediary risk. Not one depositor in the postal savings system lost a single dollar during the entire Depression-era banking collapse. Not one. The system was abolished in 1967. Not because it failed, it never came close to failing. Because the banking industry had lobbied against its existence for decades, and once the post-crisis political environment stabilized, that lobbying succeeded. Now here is what that history produces in 2026. The Treasury Department operates Treasury Direct, a direct purchase system for government securities. Any American can open an account and buy Treasury bills directly from the federal government. No bank, no broker, no intermediary of any kind. A 4-week Treasury bill purchased through Treasury Direct matures in 28 days, returning principal plus interest. The proceeds can automatically roll into the next 4-week bill. The current yield is approximately 4 to 4.25%. The counterparty is not an institution. It is not an insurance fund. It is not a clearing house. It is the United States federal government itself. Either the government repays you, or it does not. There is no intermediary failure mode between you and the obligation. No bank holiday can freeze this account. No bank run can reach it. No deposit insurance limit applies because deposit insurance is not the mechanism. Direct sovereign obligation is. When Silicon Valley Bank failed in March 2023 and a second institution followed within 48 hours, depositors who held their capital in direct treasury accounts through Treasury Direct experienced nothing. Zero disruption. The structural separation worked exactly as the historical record predicted, because the mechanism that failed was the bank intermediary, and their capital had no bank intermediary in the chain. This is the postal savings system rebuilt for the digital era. This is what the smart money already knows. This is what the people who survived the 1929 collapse without loss were using in its earlier form, while everyone else was concentrated in the institutions that failed. Now let me address the objection that always comes up at this point. If the US government defaults, none of this matters. That is true, and it completely misses the point. The scenario for which this architecture provides protection is not a US government default. That scenario would represent a systemic collapse of the global financial order in which every asset class, every institution, and every currency system would face simultaneous stress that makes individual asset positioning largely irrelevant. The scenario this architecture addresses is a banking system stress event, the historically recurring scenario that produced the 1929 to 1933 failures, the savings and loan crisis of the 1980s, the 2008 financial crisis, and the Silicon Valley Bank failure of 2023. In each of those scenarios, the US government did not default. The banking intermediary layer experienced failures. The capital that was direct with the government survived intact. That is the relevant comparison. That is the historically documented outcome. That is what the smart money has known and built for, quietly for decades. Let me close by bringing this back to the present-day signals I opened with. A bank failed in 2026. The FDIC is under administrative pressure. Congress is proposing a 40-fold increase in insurance limits. These three signals are not alarmist claims from fringe sources. They are documented, publicly observable, reported by established financial media. In 1929, the specific pressures that preceded the collapse were also visible in advance. To those who knew how to read them, France had been demanding gold redemption from the Federal Reserve for years before the shock. Gold outflows were accelerating. The call loan market supporting stock market speculation was visibly over-leveraged. The shock was sudden. The conditions that produced it were observable. The question is never whether you can see the signals. The question is whether you act on them before the event they signal or after it. The smart money moves before, the crowd moves after. The gap between those two positions is where the wealth transfer happens. This is what this channel exists to close. Not by predicting specific events, no one can do that with reliability, but by explaining the structural architecture that positions you correctly, regardless of timing, so that when the scenario arrives, your capital is already in the right structure, instead of requiring you to make decisions under exactly the conditions that make good decisions hardest. The four-layer architecture exists. Each layer is available to any American right now. The postal savings system equivalent, Treasury Direct, has been there the whole time. The structural separation is real and has been historically tested. The only variable is whether you build it before you need it or after. Subscribe to Capital Briefing. Activate notifications. The analysis we publish here is designed to create that positioning advantage, understanding the structural mechanisms before they become urgently necessary, which is the only point at which understanding them still creates options. Drop a comment with a direct answer. Which of the four layers represents the largest gap between where your capital is now and where this analysis suggests it should be? The smart money already repositioned. The window is still open, but windows close, usually at the exact moment when everyone suddenly understands why they needed to act.